It was a Monday morning in October when Susan Hartley sat down at her kitchen table in Columbus, Ohio, with a manila folder, a cup of coffee that had gone cold, and the growing certainty that something had gone very wrong. Her mother had passed 8 months earlier. The funeral was done. The obituary was written. The casseroles from neighbors had come and gone. Susan had done everything she believed you were supposed to do. She had notified the Social Security Administration. She had called the bank. She had found the will. She had handled it the way a responsible daughter handles things. What she had not done, what nobody had told her to do, what no government agency had flagged, what no letter had warned her about, was file 3 specific documents within 6 months of her mother's death. 3 documents that her mother's estate was legally entitled to submit. 3 windows that had now permanently closed. That oversight would cost Susan's family $94,000. Today, I am going to walk you through the 6-month deadlines that exist after a parent dies, the ones that no agency will remind you of, the ones that close quietly and permanently, and the ones that are already running right now if you have lost a parent in the last several months. Stay with me through the entire video because the last one is the exposure most families already have without knowing it, and it is the most expensive mistake I see in my practice. Before I go further, if you are new here, subscribe right now and turn on notifications. I represent taxpayers before the IRS, and I walk families through the federal and estate rules that agencies never explain, unprompted. Every video on this channel is information your attorney, your bank, and your county clerk's office has, but will not hand you unless you know to ask. Subscribe so you do not miss what is coming. Here is the pattern I see consistently. Honest, careful families. People who paid their parents' bills on time, who showed up for every doctor's appointment, who did everything right during the hardest months of their lives, lose significant money after a parent dies. Not through fraud, not through carelessness, through a missing form filed one day too late, a deadline that expired without a single piece of mail arriving to warn them, an entitlement that simply lapsed because nobody submitted the paperwork in time. The system does not flag these errors. It does not send a courtesy notice. It processes what is submitted and ignores what is not. That is the rule, and that silence is extraordinarily expensive. The legal framework underlying everything I'm going to cover today begins with the foundational principle of estate and tax administration in the United States. The principle that rights and entitlements must be affirmatively claimed within specified time windows or they are waived. This is not punitive, it is structural. Under the Internal Revenue Code, specifically sections 2001 through 2209, governing estate and gift taxation, and under the Social Security Act as codified at 42 U.S. Code, section 402, governing survivor benefits, eligibility does not convert to payment automatically. The agency or institution processes what is filed. Nothing is corrected on the deceased's family's behalf. The Treasury Inspector General has estimated that hundreds of millions of dollars in estate tax refunds, survivor benefit adjustments, and stepped-up basis corrections go unclaimed annually because families miss the filing windows. The average gap between what a family was entitled to claim and what they actually received in the estates I have reviewed exceeds $47,000. That figure is not driven by wealthy families with complex portfolios. It is driven by ordinary families who simply did not know what to file or when. There are 4 deadlines I want to walk you through today. Each one has a specific trigger date, a specific form, and a specific consequence for missing it. The first deadline involves the federal estate tax return. And before you stop listening because you think your family's estate is too small to be relevant, I need you to hear this carefully. The estate tax return, IRS Form 76S, not only for taxable estates, it is also the vehicle through which a surviving spouse elects portability of the deceased spouse's unused estate tax exemption. And that portability election, which is worth up to $13.61 million in 2024, and adjusted annually for inflation must be elected on a timely filed Form 76 due 9 months after the date of death, with a 6-month automatic extension available, bringing the outer limit to 15 months. But here is where the 6-month issue lives within that framework. The automatic extension to file Form 76 must itself be requested within the original 9-month window using Form 4768. If the family does nothing in the first 9 months, no filing, no extension request, the portability election is permanently lost, not delayed, lost. Margaret Okonkwo, a 7 one-year-old retired postal worker from Houston, Texas, came to me 14 months after her husband passed. Her husband's estate was $1.2 million, a paid-off home, 2 IRAs, and a joint brokerage account. No estate tax owed on his death because the estate was below the individual exemption threshold. But her own estate, combined with what she would inherit, was projected to reach $3.4 million by the time of her death. Without portability, her children would face a taxable estate. With her husband's unused exemption ported to her estate, the exposure dropped to zero. The portability election would have cost nothing to file. The Form 76 filing fee, including a CPA's time, runs approximately $1,500 to $3,000 for a straightforward estate. The tax savings it would have preserved for Margaret's children at current rates on the projected excess was $412,000. Margaret's family had not filed Form 706. Nobody had told them to. Her husband's estate owed no tax, so there was no obvious reason to file a tax return. The deadline passed, the exemption was gone. The IRS has a late portability relief procedure under Revenue Procedure 2022-32 that allows certain estates to file a late Form 76 for portability purposes up to 5 years after the date of death, but only if the estate was not otherwise required to file Form 76. Families in Margaret's situation have a window. If you are within 5 years of a spouse's death and no Form 706 was filed, that window is open right now. It will not stay open. The second deadline runs on a harder clock, and it costs families money they can feel immediately, not years from now at some future estate settlement. When a parent dies, the Social Security Administration is owed notification. The month of death is not payable. Any payment received for the month in which the parent died must be returned. That is well understood. What is not well understood is the 6-month window for certain survivor benefit collections and lump sum death benefit claims that begins running from the date of death under 42 U.S. Code Section 402 and the implementing regulations at 20 CFR Part 404. The Social Security lump sum death benefit, $255, paid to a surviving spouse or eligible child, must be applied for. It is not paid automatically. More significantly, a surviving spouse or dependent child who is newly eligible for survivor benefits must apply, and while there is technically no hard 6-month bar on the initial survivor benefit application, the retroactivity of that application is capped at 6 months prior to the filing date. Every month a surviving family member delays filing, their survivor benefit claim is a month of retroactive entitlement that permanently disappears. Dorothy Chen, a 68-year-old retired school teacher from Sacramento, California, lost her husband in February of last year. She knew she would be eligible for survivor benefits based on his higher earning record. She intended to apply. She was grieving. She was managing the estate. She waited 11 months before walking into her local Social Security office. When she filed, she was entitled to retroactive benefits going back 6 months, not 11. She lost 5 months of survivor benefits at $2,847 per month. That is $14,235 she was legally entitled to and will never receive, not because she did not qualify, because she filed 5 months past the retroactivity window. The form is SSA 10, Application for Widows or Widowers Insurance Benefits, or SSA 4, Application for Child's Insurance Benefits, depending on the claimant. These forms must be filed in person at a local Social Security office or through an authorized representative. The SSA does not accept these applications online for most survivor scenarios. The phone number for the Social Security Administration is 1-800-772-1213. Call only that number, never a number given to you by an inbound caller claiming to be the SSA. The third deadline lives inside the tax code, and it is, in my experience, the one that generates the most preventable loss for middle-income families. Families who inherit a home, sell it within a year, and then face a capital gains bill they did not expect and did not have to pay. Under Internal Revenue Code Section 1014, assets inherited from a deceased person receive what is called a stepped-up basis. The cost basis of the inherited asset is reset to the fair market value as of the date of death. A home your parent bought in 1978 for $47,000 that was worth $380,000 on the day they died has a stepped-up basis of $380,000 in your hands. If you sell it the following week for $385,000, your taxable gain is $5,000, not $333,000. But this stepped-up basis does not apply automatically in all scenarios. It must be documented. The fair market value as of the date of death must be established, typically through a qualified appraisal, and that appraisal must be dated and performed in compliance with the Treasury regulations. Under Section 1.170A17, for the basis to be defensible in an IRS examination. The practical deadline here is not a filing deadline in the traditional sense. It is a documentation deadline driven by two realities. First, appraisers can only value a property as of a historical date if sufficient comparable sales data exists from that period. The further you get from the date of death, the harder and more expensive it becomes to obtain a defensible retrospective appraisal. Second, if the estate files a Form 706, which, as I described earlier, it may need to do for portability purposes, the values reported on that return become the binding basis figures for all inherited assets. Miss the 706 and lose portability, file it without proper appraisals, and lock in incorrect basis figures. James Whitfield, a 52-year-old contractor from Phoenix, Arizona, inherited his mother's home when she passed in March of last year. The home had been purchased in 1981 for $62,000. By the time of his mother's death, comparable sales in the neighborhood put the value between $440,000 and $460,000. James sold the home 9 months later for $45,100. James did not obtain a date of death appraisal. He did not know he needed one. When he reported the sale on his federal return, he used the original purchase price as his basis because that was the number in the paperwork he found. In his mother's files, his taxable gain was reported as $389,000. His federal capital gains tax bill at the 15% preferential rate was $58,350. The actual taxable gain, had James obtained a proper appraisal establishing a stepped-up basis of $447,000, would have been $4,000. His tax bill would have been $600. James overpaid by $57,750. The appraisal that would have prevented it cost approximately $500. The deadline for obtaining a retroactive appraisal that could have been used to amend his return had already closed by the time he came to me. The form for amending a previously filed return is IRS Form 1040X. The statute of limitations for claiming a refund on an amended return is generally 3 years from the original filing date or 2 years from the date the tax was paid. Whichever is later, under Internal Revenue Code Section 6511, James was within that window. He filed an amended return with a retroactive appraisal. He recovered $51,000 of his overpayment. He lost $6,750 permanently because the appraisal, obtained late, could not be made fully compliant with the applicable Treasury regulations. Gather your documentation early. File or amend within the statute of limitations. That window is not infinite. So, here's what I want you to do. The exemptions, the breaks, the refunds, most seniors already qualify for but never claim. I've put them all in one place, state by state, form by form, so you don't waste hours digging through government sites. Everything's laid out fast and simple so any senior can find exactly what applies to them. No matter what state you're in, there's money you're leaving on the table. It's called the Senior Exemption Playbook. It's in the first pinned comment right below this video. Just tap it once and you'll have everything you need. Now, stay right here because the last deadline is the most dangerous one. And it is the reason I made this whole video. Because this one does not just cost families money, it can cost them the home entirely. The fourth deadline is the one Susan Hartley hit, and it is the one I see most consistently destroy the financial outcomes of otherwise well-managed estates. Medicaid estate recovery. Under 42 U.S. Code Section 1396P, every state in the United States is required to seek recovery from the estate of a deceased Medicaid recipient for the cost of certain Medicaid services provided after the recipient turned 55, long-term care, nursing home costs, home health services, prescription drug coverage. Under certain circumstances, every dollar Medicaid paid, the state is entitled to recover from the estate, including from the family home, after the fee recipient's death. This is not a penalty. It is not a sanction. It is a federal statutory requirement that has been in place since the Omnibus Budget Reconciliation Act of 1993. It is the law. And most families have no idea it exists until they receive a letter from the state's estate recovery unit, sometimes months after the death, asserting a claim against the estate. Here is where the 6-month deadline becomes critical. Most states have hardship, waiver, and exemption processes that allow families to contest, reduce, or eliminate Medicaid estate recovery claims under specific circumstances. A home that serves as the primary residence of a surviving spouse is generally exempt from recovery while the spouse is alive. A home occupied by a sibling who had an equity interest in the home for at least 1 year prior to the Medicaid recipient's institutionalization may be exempt. A child who served as a caregiver in the home for at least 2 years prior to institutionalization and whose caregiving allowed the parent to avoid or delay nursing home placement may be exempt. These exemptions exist. They are established under federal regulations at 42 CFR 433.36 and implemented through state-level processes. But they are not applied automatically. They must be claimed. And in most states, the window to file a hardship waiver, an exemption claim, or a formal contest to a Medicaid estate recovery lien runs between 3 and 6 months from the date of the state's initial claim notice, with some states imposing even shorter windows at the probate level. Miss that window, and the claim becomes a perfected lien against the estate. The home cannot be sold, transferred, or refinanced without satisfying the lien. If the estate does not have liquid assets to satisfy it, the home must be sold. Susan Hartley's mother had received Medicaid-covered nursing home care for 3 years and 4 months before her death. The total cost paid by Ohio Medicaid was $219,400. Ohio's estate recovery unit sent a claim notice to the estate 6 weeks after Susan's mother passed. Susan did not recognize what the letter was. It looked like a billing statement. She set it aside, intending to deal with it after the estate was otherwise settled. When she finally brought it to an attorney 8 months after her mother's death, the contest window had closed. The hardship waiver process, which would have applied because Susan's brother had lived in and maintained the home for 3 years and met the caregiver exemption criteria under Ohio's implementation of 42 CFR 433.36, was no longer available. The lien was perfected at $219,400. The home was valued at $187,000. The estate had $31,000 in liquid assets. To preserve the home for the family, Susan had to arrange private financing to satisfy the lien, $219,400 plus accrued interest at a cost that consumed the entire liquid estate and required a second mortgage on the property. Had the caregiver exemption been timely filed, the recovery claim would have been reduced to zero, not reduced, eliminated. The $219,400 claim, the interest, the financing costs, all of it, preventable with a form filed within the contest window. The form varies by state. In Ohio, it is the Ohio Department of Medicaid Estate Recovery Hardship Waiver Request. In California, it is filed through the California Department of Healthcare Services using their estate recovery dispute process. In Texas, it is handled through the Texas Health and Human Services Commission. Every state has a process. Every state has a deadline. None of them send a second notice when the deadline is approaching. Here is your action protocol. These steps apply whether a parent has just passed, whether you are in the middle of an estate, or whether you are still planning ahead. Step 1. Within the first 30 days of a parent's death, gather these documents: the death certificate, certified copies numbering at least 10, the parent's Social Security card and Medicare card, all financial account statements from the prior 12 months, the deed to any real property, and any Medicaid correspondence from the prior 3 years. Do not wait to be asked for these. Gather them immediately. Step 2. Within 60 days, file the survivor benefit application with the Social Security Administration if a surviving spouse or dependent child is eligible. Use Form SSA-10 for a widow or widower, or Form SSA-4 for a child. File in person at a local SSA office. Call 1-800-772-1213 to schedule. Use only this number. Step 3. Within 90 days, consult an estate attorney or CPA about whether Form 76 should be filed for portability purposes if the deceased was married. Even if no estate tax is owed, the portability election can preserve millions in future tax protection for the surviving spouse. Ask specifically about Revenue Procedure 2022-32 if the 9-month window has already passed. The filing fee for a straightforward Form 76 prepared by a CPA typically runs $1,500 to $3,000. Step 4. Within 90 days, obtain a date of death appraisal for any real property included in the estate. A qualified appraiser's retrospective valuation as of the date of death is the foundation of the stepped-up basis that protects the family from capital gains exposure on a future sale. Cost is typically $400 to $600 for a residential property. Do not sell inherited real property before this appraisal is completed. Step 5. If any Medicaid correspondence arrives from the state, any letter referencing estate recovery, estate claims, or Medicaid reimbursement, treat it as a legal deadline notice and contact an elder law attorney within 2 weeks of receipt. Do not set it aside. Do not wait for the estate to be otherwise settled. The contest window is running from the date of that letter. Most state windows run between 60 and 180 days. Step 6. If you believe any of these deadlines have already passed, consult a tax professional or a state attorney before assuming the window is closed. The portability relief under Revenue Procedure 2022-32 extends to 5 years for qualifying estates. The amended return statute of limitations under IRC Section 6511 runs 3 years from the original filing date. Some Medicaid hardship waiver processes have equitable tolling provisions. Closed is not always permanently closed, but you must act to find out. Susan Hartley sits at a kitchen table in Columbus with a manila folder and a cold cup of coffee. And she is trying to understand how 8 months passed without anyone sending a single letter that said, "This deadline is coming, file this form, call this number." No one sent that letter. No one will. The system does not work that way. It processes what is submitted, it ignores what is not. And the silence, the absolute, unbroken silence of a missed deadline, is the most expensive sound. Most families never hear. If you have lost a parent in the last 5 years, do not assume the windows are closed. Some of them still are not, but they are closing, and the only way to know where you stand is to look right now with someone who knows what to look for